Have you ever felt like something in the financial world just isn't right? That the numbers on your screen don't quite match the reality you feel? Today, we're diving into a fascinating and, frankly, unprecedented situation brewing in the precious metals market, particularly with silver. What we're witnessing isn't just market volatility. It's a fundamental breakdown between paper promises and physical reality. I've never seen anything like this. This is the term that everyone keeps throwing around, the word backwardation. Backwardation is an environment that shows extreme delivery stress. It's unprecedented. This isn't just volatility in my mind, it's the market exposing the shortages of physical silver, the frailty of the paper promises. That's Andy Schechtman, and he's talking about a phenomenon called backwardation. For most commodities, the price for future delivery is usually higher than the immediate spot price. This is known as contango, reflecting the cost of holding and storing the commodity over time. But when the immediate spot price is higher than the futures price, it's called backwardation. Backwardation in a commodity like silver signals something crucial, an urgent, immediate demand for physical metal that cannot be easily met by existing supplies. It's an environment of extreme delivery stress, indicating a systemic shortage. This stress is manifesting most acutely in markets like London. Consider this. London has an estimated 140 million ounces of silver readily available, yet they're reportedly trading over 600 million ounces a day in contracts that are technically deliverable. What could possibly go wrong? This huge disparity points to a massive over-leveraging of paper silver compared to the actual physical metal. The entire Western financial system has relied on these paper promises for a very long time, but that foundation is starting to crack. The lease rate in silver in London, when you lease silver in London, normally that lease rate is somewhere in the neighborhood of 0.5% or 1%. In October, it's jumped up over 39%. And at the same time, we've seen silver rise since August, when the lease rate was at about 1%, up to $53 here. So you see the price rising, the lease rates rising. This astronomical jump in silver lease rates is a direct consequence of the physical shortage. When you want to short silver, you borrow the physical metal, sell it, and then buy it back later at a lower price to return it. But when there's very little physical silver to borrow, the cost of leasing it skyrockets. A normal lease rate might be 0.5% to 1%, but a jump to over 39% indicates a desperate scramble for physical silver. This means traders holding short positions are getting squeezed hard. Buyers are very desperate for immediate delivery. It signals urgent demand, depleted inventories, and really a systemic shortage of deliverable bars. That's all because of rehypothecation. In other words, it's getting called on the carpet. You are beginning to see margin calls for traders out there who are receiving a margin call because the price is going against their short position, and the lease rate and the borrowing costs are so high that they are not able to get the silver to cover their position. And that's when things begin to get very, very, very interesting. As lease rates climb and silver prices rise, traders with short positions face increasing pressure. If they can't acquire physical silver to cover their shorts, they face margin calls, leading to forced liquidation. This isn't just about financial instruments. It's about the real-world demand for a tangible asset that isn't readily available. Andy points out that buyers are no longer just rolling over their contracts like they used to. They are standing for delivery, demanding real metal, and these delivery numbers are well above normal. This indicates a profound shift in market behavior. What it really tells us is that buyers aren't just rolling over their contracts like they used to. They're standing for delivery. They're demanding real metal. The short-term implication would be liquidations and survival-driven selling can trigger volatility, even sharp pullbacks. That's the short term. Medium term, as far as I'm concerned, is that once this forced selling ends, the physical scarcity starts to dominate, and silver sustains its higher prices, $50 plus. The long term, if confidence in this paper system collapses like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. $75, $100. Looking at the charts, some technical analysts identify a 45-year cup and handle pattern in silver. According to this analysis, once silver definitively breaks through $50, the next technical target could be $96. This isn't just speculative. It reflects the underlying supply and demand fundamentals finally asserting themselves over decades of paper market manipulation. This market shift is happening within a broader global context. For the last 40 to 50 years, the United States has largely pursued a strategy built on a strong dollar, U.S. bonds, and service-based jobs. Meanwhile, the rest of the world, particularly the BRICS nations and China, has done the opposite. They've focused on building factories, accumulating commodities, and hoarding gold, pushing away from reliance on the dollar. This macroeconomic divergence is now playing a critical role, as global demand increasingly shifts towards tangible assets. The premiums are jumping noticeably on the Eagles, and this is exactly what we saw during the pandemic. The premiums on Eagles, every major dealer in America right now is north of $6, $7, $8 an ounce over spot. Right now, the biggest distributor, one of the biggest distributors in America, their cost on selling me silver Eagles that will be north of $6 over spot. That's before I make a penny. They have no platinum, zero in stock. We're beginning to see a system where the paper versus physical divide is breaking. The credibility of paper, silver, and gold and platinum futures is eroding. The impact of this shortage isn't just felt by large institutional players, it's hitting the retail market too. Premiums on physical silver, like American Silver Eagles, are surging, reaching $6 to $8 an ounce over the spot price. This indicates a massive spread between buy and sell prices, making it incredibly difficult for dealers to maintain inventory and hedge their positions. The U.S. Mint itself, often criticized for inefficiency, struggles to keep up with demand. Most people are going to be caught off guard by this, and it will go from an environment of high prices that will identify the market to most people, to your people saying, geez, I can't get it easily, it's disappearing. You get Look, let me put it to you this way. Goldman Sachs said if the market even suspects for a moment that the Fed is losing independence and 5% of the money that is embedded in treasuries shifts to gold, the price will go parabolic. Andy believes that while many will be caught off guard, smart money is already recognizing these systemic shifts. Large players and sophisticated investors are demanding physical settlement, understanding that something fundamental in the financial system has broken. The takeaway is clear. The paper precious metals market, with its endless claims and derivatives, is increasingly diverging from the finite reality of physical supply. As confidence in paper promises erodes and demand for tangible assets intensifies globally, the value of physical silver is poised for a significant repricing. Those who understand this fundamental shift and act accordingly will be in a far stronger position as this new era unfolds.